Listen up, people. We have huge financial news hitting the biotech world right now. And if you missed this move, you missed out on massive, instant cash gains. We're talking about one of the biggest pharmaceutical takeovers of the year. The news is simple. Novartis, the giant drug maker, is buying Avidity Biosciences. They aren't just buying it, they are throwing down serious money. Novartis is shelling out an insane amount, about $12 billion in cash for Avidity. This deal is so massive that it ranks as the second biggest pharma deal this year, only behind Johnson & Johnson's huge purchase back in January. This tells you just how hot the drug industry is right now. Let's look at the price tag. Novartis is paying $72 per share for Avidity stock. Now, get this. That is a crazy premium. It's a whopping 47% jump over where Avidity stock closed just a few days ago. Think about that for a second. If you held Avidity stock, you just got almost 50% richer overnight. This kind of enormous premium immediately sends one message to the market. Novartis wants Avidity's technology, and they want it badly. So what exactly did Novartis just buy for $12 billion? They bought the future of muscle medicine. Avidity is a specialist in something called RNA therapeutics. Now, don't let those big words confuse you. This is ridiculously simple. Most traditional drugs are like giant keys trying to fit into locks, but RNA therapies are like tiny secret instruction manuals. They tell your body's cells how to handle diseases right at the source, altering how your genes work. The problem has always been getting these instruction manuals to the right place. Most of these RNA drugs can only easily reach the liver. But Avidity developed a special platform they call AOCs. Think of AOCs as a guided missile system. It combines a targeting mechanism, a monoclonal antibody, with the tiny RNA drug payload. This missile system allows them to specifically target and deliver these instruction manuals directly to muscle tissue, a place that was previously almost impossible to reach. This is a breakthrough, folks. It's a game changer for people suffering from devastating rare muscle diseases. Novartis is especially interested in three late-stage treatments Avidity has cooking up. First, they have a treatment for Duchenne muscular dystrophy, or DMD. This is a severe disease that usually hits kids early, causing progressive muscle damage. Avidity's lead drug for this, called zotocin, showed promising results in trials. The company is already on track to file for approval with the Food and Drug Administration early next year, in the first quarter of 2026. Second, they are getting treatments for myotonic dystrophy type 1, or DM1. This is a rare disorder that causes progressive muscle loss and disability, and right now there are absolutely no approved treatments that can modify the disease. This is a huge unmet need, and Novartis sees a chance to be the first. Third, Novartis scoops up a treatment for facioscapulohumeral muscular dystrophy, or FSHD, which causes relentless loss of muscle function. Novartis CEO said that acquiring Avidity's platform and these late-stage assets will strengthen their promise to deliver innovative, targeted medicines to treat these awful, progressive neuromuscular diseases. They expect this deal to unlock multi-billion-dollar opportunities and lead to new product launches before 2030. In fact, Novartis is so confident in this deal that they raised their expected sales growth rate for the next few years from 5 to 6% thanks to Avidity's pipeline. That's huge confidence baked right into their forecast. Now, before the big purchase closes in the first half of 2026, there's a crucial side story happening. Avidity isn't giving Novartis everything. They are spinning off their early-stage heart disease programs into a brand new, publicly traded company. This new company, sometimes called SpinCo, will focus on precision heart medicine programs. And guess what? This new company is starting off with a war chest of about $270 million in cash. This separation is a requirement for the Novartis deal to go through, and Avidity shareholders get one share of this new heart company for every 10 Avidity shares they currently own. Okay, so Avidity stock soared over 40% instantly, hitting an all-time high of about $70. But the real story for us traders is the domino effect this deal had across the entire sector. Enter Dyne. Dyne is Avidity's chief competitor. They are also developing similar RNA treatments for rare muscle diseases like DMD and DM1, using their own technology called the FORCE platform. When one player in a niche market gets bought out by $12 billion, analysts and investors suddenly realize how valuable the whole space is. The Novartis acquisition isn't just about avidity, it's a massive endorsement that this RNA to muscle approach works and is worth a premium price. And that belief sent Dyne's stock through the roof. Dyne shares instantly skyrocketed, soaring roughly 40% in pre-market trading, all because Novartis validated the whole field. It confirms that if one competitor is worth billions, the remaining competitor is now in a much, much better market position. Analysts are jumping all over Dyne now. Why? Because the acquisition clears the competitive clutter and shines a huge spotlight on Dyne's progress. Dyne has its own major drug candidates in development and expects key data readouts in the next year or so. This has investors excited about Dyne's own path to approval, which could come as early as late 2026. Now, let's keep it real. Dyne is a clinical stage company. That means they have zero revenue right now. They've been spending heavily on research, which is why they have a negative operating income of about $171 million. However, they have a lot of cash on hand, showing they have strong resources to fund their pipeline. But remember that valuation is complicated here. Analysts are optimistic, giving Dyne a buy consensus and a price target as high as $48 per share. That suggests an immense potential upside. But some metrics show that the stock is already trading at a premium compared to the average biotech company. The stock's price-to-book ratio is high, sitting at about 4, suggesting investors are paying a big price for the company's future potential, not its current earnings. Also, Dyne is highly volatile, way more volatile than the average stock, which means you need to be prepared for big price swings. The key takeaway is that this monster acquisition of Avidity by Novartis is not just a payday for Avidity shareholders, it's a powerful validation of the entire RNA therapeutic approach for rare muscle diseases. It tells everyone that this science is ready for prime time and that the big pharmaceutical companies are willing to pay top dollar to grab these new treatments. For investors, this acquisition highlights the risk and reward of biotech. Avidity shares were already up a phenomenal 69% this year, before the deal was even announced. And then they shot up another 40% in a single day. When deals like this drop, they prove that breakthroughs in the lab translate directly into huge returns in the market. Whether you are in Avidity, watching Dyne, or just curious about this huge money move, pay attention. The competition in the rare disease space is fierce, and the stakes are $12 billion high. All right, that's the breakdown of this massive biotech boom. If you found this simple explanation useful, smash that like button. Make sure you subscribe to the channel so you don't miss any of these major market moves, and hit the bell so you get notified every time we drop a new video. We'll catch you next time.